December 10th, 2008. A luxury apartment in Manhattan. Two grown men walk out of their father's home, pale, shaking. Their father is one of the most respected men on Wall Street. A legend. A former chairman of the NASDAQ stock exchange. And he has just told them a secret. The investment fund. The returns. The empire their family name is built on. All of it, he said, is one big lie. Within 24 hours, the FBI will knock on his door. And the world will learn that the most trusted man in finance ran the biggest financial scam in history. This is the story of Bernie Madoff. To understand how he fooled the world, you have to understand why the world trusted him. Bernie Madoff was not some fast-talking stranger with a briefcase. He built his firm in 1960, starting with about $5,000 he had saved from working as a lifeguard and installing sprinkler systems. And in the beginning, the firm was real. More than real. It was brilliant. Madoff was a pioneer of electronic trading, one of the people who helped drag Wall Street out of the paper age. His market-making business handled a serious share of New York stock orders. He became chairman of the NASDAQ stock exchange. Regulators asked for his advice. He sat on industry boards. When the government wanted to understand markets, they called Bernie. Think about what that means. The man running the biggest fraud in history wasn't hiding from the system. He was the system. And then there was the fund. Madoff ran a private investment business on the side, and its results were beautiful. Around 1% a month, 10 to 12% a year after year. Through booms, through crashes, through everything. But here was the genius part. You couldn't just invest. You had to be invited. Madoff turned his fund into a private club. He worked the country clubs of New York and Palm Beach. He said no to people, publicly. And every rejection made the club more desirable. Wealthy families begged to get in. Charities trusted him with their endowments. Celebrities, banks, pension funds. Money flowed in from all over the world, often through so-called feeder funds that collected billions from ordinary investors who had never even heard Madoff's name. So what was he actually doing with all that money? Here is the uncomfortable answer. Nothing. Almost literally nothing. On paper, Madoff claimed to run a sophisticated strategy with stocks and options. Impressive words. In reality, the money went into a bank account. When clients wanted to withdraw, he paid them from that same account. Old investors were paid with new investors' money. That's the whole trick. That is the entire machine. It's called a Ponzi scheme, named after Charles Ponzi. In 1920, Ponzi promised Boston investors he could double their money in 90 days using postal reply coupons. He couldn't, of course. He simply paid early investors with money from later ones. And for a few glorious months, he was the most celebrated financier in America. Then it collapsed, and his name became a warning. The scheme has one rule, and only one. As long as more money comes in than goes out, nobody notices anything. The fake empire had a real address. The 17th floor of the Lipstick Building in Manhattan. While the legitimate trading business hummed away upstairs, the 17th floor printed lies. Fake account statements. Fake trade confirmations for trades that never happened, generated on an aging computer. Clients opened their envelopes every month and saw exactly what they wanted to see. Steady, calm, beautiful profits. Which raises the obvious question. How does a $65 billion fraud survive for decades in the most regulated market on Earth? First, those steady returns. To investors, smooth profits looked like proof of skill. To anyone who understood markets, they were proof of the opposite. Real markets breathe. They rise and crash. Nobody earns 1% a month for decades in a straight line. The most comforting thing about Madoff was, in truth, the most damning red flag. Second, his reputation was armor. When a former NASDAQ chairman tells you your money is safe, doubting him feels absurd. Doubting him out loud feels dangerous. Big banks did quiet reviews, saw numbers that made no sense, and simply chose not to invest. They protected themselves. They didn't warn anyone else. Third, the details were quietly absurd. A fund claiming to manage tens of billions of dollars was audited by a 3-person accounting firm in a strip mall outside the city. One partner was retired and living in Florida. Billions of dollars, checked by essentially one man next to a pediatrician's office. And fourth, nobody could actually verify anything. Madoff's operation was a black box. He wouldn't explain the strategy in detail. Investors accepted the secrecy as part of the mystique. The genius doesn't reveal his recipe. But here is where the story turns. Because someone did figure it out. Not a regulator. Not a bank. A private math nerd in Boston named Harry Markopolos. In 1999, Markopolos' bosses gave him a task. Madoff's fund is crushing us. Copy his strategy. Markopolos sat down with the numbers. Within hours, the math told him something chilling. These returns were impossible. The strategy Madoff claimed to use could not produce them. There weren't even enough options in the entire market to run it at Madoff's size. There were only two possibilities, he concluded. Madoff was either running an illegal front-running operation or the world's largest Ponzi scheme. Markopolos went to the SEC in 2000. Nothing. He went again in 2001. Nothing. In 2005, he sent them a written report with a title that could not be clearer. The world's largest hedge fund is a fraud. It listed 29 red flags. The SEC did look at Madoff more than once over the years. They asked questions. They accepted answers. One phone call to verify his claimed trades with the clearing system would have collapsed the entire scheme in a single afternoon. That call was never made. The scheme did not need to be perfect. It only needed the money to keep flowing in. And then, in 2008, the money stopped. The global financial crisis hit, and panicked investors everywhere needed cash. They weren't suspicious of Madoff. Most still believed in him. They just needed their money back. Withdrawal requests poured in, $7 billion worth. And of course, the money wasn't there. It had never been there. It had been paid out, spent, and burned over decades. By early December, one of the largest funds on the planet had only a few $100 million left in the tank. Madoff did the math. It was over. On December 10, 2008, he confessed to his sons. The fund was, in his words, one big lie. His sons called a lawyer. The lawyer called the authorities. The next morning, FBI agents arrived at his apartment. The agent asked if there was some innocent explanation. Madoff answered, quote, "There is no innocent explanation. The numbers that came out were beyond belief." Client statements showed almost $65 billion across 4,800 accounts. Money that, for the most part, had never existed. The real cash losses were smaller but still staggering, somewhere near $18 billion of principal, real savings from real people. And the victims were not just billionaires. Charities collapsed. A Nobel Peace Prize winners' foundation was wiped out. Retirees who thought they were safely wealthy discovered, in a single morning, that they owned nothing. Some victims took their own lives. And the tragedy reached Madoff's own family. Exactly 2 years after the arrest, his son Mark died by suicide. And where did all that money actually go? People imagine a hidden mountain of gold. There wasn't one. Yes, there was a penthouse, homes in Palm Beach in France, a yacht named Bull. But the lifestyle was pocket change compared to the fraud. The truth is stranger. Most of the money went right back out the door, paying fake profits to earlier investors. A Ponzi scheme doesn't store wealth. It devours it. The scam spent decades eating itself. In March 2009, Madoff pleaded guilty to 11 federal crimes. At sentencing, the judge called the fraud extraordinarily evil and gave him the maximum, 150 years in prison. Madoff told the court, "I leave a legacy of shame." He died behind bars in 2021. But this story has one final twist that almost nobody knows. After the collapse, a court-appointed trustee spent years hunting the money, clawing back the fake profits that early investors had withdrawn. Piece by piece, lawsuit by lawsuit, he recovered over $14 billion, the vast majority of the real principal that was lost. It is one of the greatest financial recoveries in history. The paper billions were always fantasy. But much of the real money, remarkably, found its way home. So what does Bernie Madoff actually teach us? Not that markets are evil. The lessons are sharper than that. Returns that never go down are not skill. They are a warning. Reputation is not proof. The more impressive the name, the fewer questions get asked, and fraud lives exactly where questions die. Secrecy is not sophistication. If you cannot understand where the returns come from, you are not investing. You are believing. And exclusivity is a sales trick as old as money itself. The harder something is to get into, the less anyone checks what's inside. He was the most trusted man on Wall Street. And that was precisely the problem. Nobody audits a legend. Could it happen again? It already does, in smaller Ponzi schemes uncovered every single year. The names change. The math never does. So, be honest with me. Have you ever been offered an investment that felt just a little too good to be true? Tell your story in the comments.